when portfolio manager David Lipner said he was quitting billionaire Izzy Inlander's Millennium management to join a rival, the hedge fund countered with an unusual proposal: a one-year proposal, different sabbatical, and an incentive upon return if Lipner stayed. And stay he did. For Millennium, the $58 billion industry giant known for ruthlessly cutting underperformers, the generous offer was seen as totally worth it. After all, Lipner had seen to Travelodge and Maver Filmley speak to the battle of the fund, made money for the firm for more than a decade, longer than most hedge funds remain. Such enticements are now becoming part of a growing array of expensive tools the world's biggest hedge funds are deploying to hire and retain traders. They show how a limited pool of talent and surging demand for steady returns in a volatile market are prompting firms to pull out all the stops to attract the best. The hunt is no different from the bidding war for Premier League or NBA players. One executive said last year a senior portfolio manager was lured by a major New York fund with more than $120 million in guaranteed payouts, according to a headhunter who said he'd done several deals paying north of $50 million. Contracts worth $10 million to $50 million are increasingly becoming common for traders, said another. And hedge funds have long been the land of eye-popping rewards, but a few recent trends are converging to take it to new levels. The stellar track record of several giant firms that spread money across teams of traders following multiple strategies has caused their assets to surge. So that's prompted a hiring spree to add more traders and strategists so the existing ones aren't overstretched. And the performance and resulting waylist of investors wanting in has also given the firms leverage over clients to charge many times the traditional 2% management fee and use that for recruitment and retention. And as the firms increase rewards and defer more of them over several years, it's taking even bigger offers to tempt traders into leaving. In a world where there's a lot of liquidity, the bigger challenge in developing a platform business is investing in talent rather than attracting capital, said Chris Miller, the chief operating officer, London-based Isla Capital, which is transforming itself into a multi-strategy hedge fund from its roots in macro trading. And Lipner wasn't the only one offered the sabbatical by Millennium. People familiar with matter said, and the New York-based firm recently dangled similar deals at several others. They said asking not to be identified, discussing internal matters, and one of them quit anyway. Showing such base don't always do the trick. Lipner didn't respond to requests for comment. A stay after experience as representative for Millennium declined to comment. Millions of dollars in signing bonuses and a higher cut of trading profits during initial periods aimed at replacing any pay lost from leaving the past employer, and having to sit out non-compete periods are now becoming the norm at multi-manager investment firms ranging from Millennium, Citadel, Point72 Asset Management, to Blue Crest Capital Management and Ballast Asset Management. While the rest of the hedge fund industry grapples with assholes, the biggest are baking up. Clients mostly do not get to see details of the payouts and guaranteed bonuses, though they foot the bill for an opaque blank check for a pass-through fee. And that payment allows hedge funds to charge clients for anything from compensation and research to entertainment. And clients also can be on the hook for expenses such as fitness plans for traders at Point72, relocation expenses at Payouts, investment and litigation related costs at Verition Fund Management, and Millennium's Keyman Life Insurance on Englander for the fund, according to their client offering documents reviewed by Bloomberg News. A Point72 spokeswoman said, though the fitness plan costs are included in the offering document, they are not currently passed on to customers. She declined to comment further. It's not a scandal, and I am intellectually not against higher fees, but Multi-PM hedge funds are setting the bar too high, said Mary O'Malley, a senior money manager at Kairos Partners that invests in hedge funds. It doesn't seem to be a limit to the hedge fund compensation scheme. The traditional 2 and 20 fee model, hedge funds once employed, meant that for a 20% gross return, the firm took about 1/3 of the gains, and the plans got the rest. A rough calculation by Sebastian Sereau, Chief Investment Officer at Blue Lotus Management, that also gives money to hedge funds, shows fees have gone so high at multi-manager platforms that investors on average get back only about 45% of the trading profits, and the firms take the majority. So far, even after the higher fees are accounted for, the net performance of the biggest firms is still attracting investors. And the most obvious place for those firms to recruit new talent is from each other. A flurry of such moves has also brought conflicts, litigation, and punitive measures to try to avoid changes of heart. And so some multi-strats have found success convincing promising traders to close up their own shops, even when they're doing well. I interviewed Sean Gambino, who ran his own hair and Bay Capital, into shuttering it. Schoenfeld Strategic Advisors persuaded famed trader Ben Melkman to abandon his plans for a hedge fund startup and instead run strategy for its own macro business. More than a quarter of Balyasny's investment team recruits came from single manager firms last year, according to a person with knowledge of the matter. A representative for Balyasny declined to comment. And when hedge funds aren't poaching talent from rivals, they are devising ways to lock in their own traders. One tool is the multi-year non-compete agreement, a practice that's come increasingly under scrutiny globally, with the U.S. Federal Trade Commission proposing a ban in January in the UK, planning to limit the restriction to 3 months. Yet the use of the clause is widespread, and even some firms that want to shoot it are changing their tune. When Exodus Point of Capital Management debuted 5 years ago as the biggest ever hedge fund startup, it typically had traders sign a standard employment contract with a 3-month exit notice. They could even walk away with their trade secrets, but of late, the $12.7 billion. Exodus Point has been resorting to non-compete contracts that stretch a year or longer. That comes as it adds top managers, including Pete McConnon, previously the co-head of macro trading in London for Balyasny, and Patrick Olson, the former chief investment officer of Netcar Asset Management. Hedge funds are also looking beyond financial incentives to retain talent. Pitches include a collaborative culture, help for portfolio managers to build their teams, and greater tolerance for explainable earlier that save the trading losses. Firms expanding globally also offer flexibility to work from any location. A lot of PMs want more than a capital provider. They want a partner who can help them build a business for the long haul. Said Jennifer Blake, global head of business development at Balyasny. Competitive compensation is table stakes. The question is, how can you differentiate the seed by leveraging tech resources, data and market insights across strategies? But the standard retention method is still to make it tough to leave. Balyasny imposes longer sit-out and non-solicitation restrictions. If a trader leaves for direct competitors such as Millennium, Citadel, or Point 72, people with knowledge of the matter said asking not to be identified, discussing the internal matters. At Michael Platts, Blue Crest, payouts are deferred by 2 years, and quitters who break their contracts lose those awards. The firm pays as much as 30% of the trading profits, one of the highest rates in the industry, a headhunter said, describing it as a golden chain. Billionaire Ken Griffin Citadel also has a multi-year deferral program which allows staff to invest in Citadel funds. With its flagship hedge fund gaining 38% last year, that's another carrot to keep existing employees and lower recruits. Representatives for Blue Crest, Exodus Point, and Verition all declined to comment. But all efforts to hire the best of the best fail. Large hedge funds end up tapping top traders at smaller firms to manage hundreds of millions of dollars to externally. Millennium, where more than 290 teams of traders invest across asset classes, remains one of the most prolific employers in the industry. Still, it gave several $1 billion to be Delta Global Management and Lorenzo Rossi's Cadallion Capital Management to manage. Such external arrangements make up less than a tenth of Millennium's teams of traders, and many of the outside groups manage money exclusively for the firm, according to a person with knowledge of the matter. 172, Bluecrest, Balyasny, and Schoenfeld are among those that have given money to external teams through so-called managed accounts that still give them control. Just over half of all the multi-manager hedge funds now allocate to outside traders, according to Goldman Sachs, said they allocate well more. Even the biggest hedge funds have become meaningfully more flexible to win the bidding war for talent because there's so much more capital in the space and so many more firms trying to emulate successful players. Said Marlon Naito, global head of capital introduction and consulting at BNP Paribas. But poaching traders is still the most common approach, with one top industry executive describing multi-manager firms as the apex predator. Those firms manage just 8% of the industry assets. They employ 24% of total staff, according to estimates by Goldman Sachs. The market is absolutely competitive, but we're in it to compete for the best talent, said Danielle Pizzo, Schoenfeld's chief strategy officer. And we're flexible. We customize our offering in ways that others don't, or she said, adding that the approach is ensured that only 3 portfolio managers left voluntarily over the last decade. There's even been hiring to enable more hiring. When Schoenfeld launched its discretionary macro and fixed income business in 2021, the firm brought on individuals within the unit reporting to co-heads Colin Lancaster and Nitish Parikh to exclusively focus on acquiring talent. Peter Hornick, previously at Exodus Point, leads such a team at Bridge & Howard Asset Management. Eisler recently hired former Goldman partner Alain Marcus to concentrate just to contrade and secret in person, Jeff and Net. Still, for investors who pay for it all, the only reliable way to earn stellar returns is to keep giving money to platforms who can prevail in the race. Multi-PM platforms are first and foremost an HR business, Blue Lotus's Savoy said. We worry about some of our multi-PMs who are not keeping up with the bidding war or provide subpar environment for the traders.